the good news is for those that doesn't have access to Icon, you can actually use break-even inflation rates on TradingView as well. So I'll go ahead and show you guys how to recreate both, whether you're using Icon, whether you're using TradingView. The only challenge when it comes to the TradingView version is that it will have a lag of about a day. So you'll only get updated as the day rolls over. So you won't have a live feed compared to like you have with something like Icon. So let's start at the beginning and just take a quick look at how we use this information to trade oil. Now we can clearly see that very strong positive correlation between something like oil and inflation expectations. This goes back all the way to 2013, and the further you take out that chart, you'll see that correlation normally holds. Now, why do we have that strong positive correlation between something like oil and something like inflation expectations? Is because sometimes these two can go hand in hand. Sometimes it might be difficult to tell which one is driving which. Is it oil prices rising causing inflation expectations to go up, or is it inflation expectations going up causing oil prices or commodity prices to rise? Sometimes it can be a little bit of a chicken and egg game. The reason why we have such a strong correlation between inflation expectations and oil is because oil is such a massive part of the global economy, right? We use it every single day. We use it to get to work. Even those of us that is using might be using electric vehicles. I haven't made that transition myself, but where does your power come from? Your power might be coming from fossil fuels. So we use it for day-to-day travel. We use it for public transportation. We use it for air travel. We use it most importantly for distribution, right? Think about all the massive amounts of trucks out there that needs to take stock and distribute them from point A to point B. So think about the price of oil in relation to what it means for us from a day-to-day living perspective, or a living point of view, right? If it costs more oil to fill that distribution truck, that cost will need to be pushed through to the buyer of that stock. So if you're the distributor, you're obviously going to need to be raising your prices. If you're raising your prices, the person that's selling the stock will need to start raising their prices. At the end of the day, it's going to hit your pocket as a consumer. Whether that is paying more for your air tickets, whether it's paying more for your public transportation, oil prices is massively important for the global economy. And because it's such a huge part of our day-to-day lives and used in massive quantities, we consume massive amounts of the stuff. It really matters. The price really matters because it has repercussions for the overall view of inflation. Now, obviously, you can strip out the noisy effects like energy, like food, etc., but it's stuff we use every day, right? So the price matters, and it matters for central bankers because obviously when inflation gets out of hand, they need to step in, like we've seen, the likes of the Fed do a little bit more aggressively recently. So that's why we have that strong positive correlation between the two. So it's important here to note that inflation expectations is just one of the drivers for the oil market, right? So because it's a commodity, supply and demand is always going to be a very, very critical component to be mindful of when it comes to commodity. Supply and demand factors is massive when it comes to oil. Think of the importance of OPEC, etc. Apart from supply and demand, obviously monetary policy has an effect. Where interest rates go normally does affect inflation, or it does affect commodities because it affects inflation and inflation expectations. We also have that inverse correlation to the US dollar, which we always need to keep in mind. So it's the dollar, it's inflation, it's supply and demand. So it's not just inflation expectations, which is very, very important. But like any asset that's correlated to something, we can use that to find when there might be opportunities for one of these markets that maybe one of these markets have gotten a little bit too overextended that needs to correct. Because you can see from time and time again, every single time that either one of these markets, either inflation expectation or oil, drifts away too far from the other one, normally we see the price needing to return and fall back in line with that overall correlation. So if we go back to where we are right now, one of the reasons, again, not the only reason, but one of the key reasons why I like oil to push lower is just because of that massive Jaws gap that we've been seeing opening up. Now, there's been supply and demand driven factors downside in the dollar recently, providing support for oil prices, but inflation expectations have been drifting lower, and we expect this to continue drifting lower as the Fed ramps up their very aggressive policy. So that very big Jaws gap is a key a key factor for us to watch and say, okay, maybe one of these markets have gotten a little bit overextended. Do we think oil here is the one that needs to correct lower, or do we think inflation expectations needs to correct higher? In this specific example, we're obviously expecting oil to correct lower and fall back in line with inflation expectations. So that's how we use it, why we use it. In terms of creating or recreating this in Icon, it's very, very simple. Just open up a new chart in Icon, and I'll show you the, let's just quickly go about and edit this, and I'll give you the two codes that you can use there. Let's just quickly change this to something that looks a little bit more familiar. Let's just go a line chart. And what you're going to do here, because it's already selected oil, CLC1, that's basically the futures contract for oil. So you can just have oil displayed. And for US break-even inflation, it's really simple. It's just US break-even BE inflation. And then you can choose whether you want to use the 1 year, the 5 year, the 10 year, the 20 year, the 30 year. Normally, I find that the 5 year runs a stronger correlation, positive correlation to oil. So there you can see that exact same chart recreated in Icon. And for those of you that don't use Icon but has TradingView, very, very simple to go about it as well. Let me just quickly find that chart for us. So here you can see we have the exact same thing. We've got oil in white, we've got the CRB commodity index in yellow, and then we've got 5 year break-even inflation. So if I just quickly hide the CRB index, you can see it's the exact same chart in this one. The only challenge, of course, like I said, is that this one gives you a more real-time view. Where it comes to TradingView, you're going to have a little bit of a delay in that data feed. So the symbol for WTI, you can just search any one that you want. There's so many different versions. For this one, I've just used WTI, the Oanda feed. And then for break-even inflation rates, this one can be a little bit tricky. Let me just show you guys what that code looks like. It is Fred /T5 5-year inflation, but you need to copy that entire code because it's actually getting from an outside source called Quandl. So you need to take that entire code like that. Maybe you guys just want to take a quick screenshot of this, but that's the code that you want to take. Replicate that completely, and then when you punch it in, don't wait for it to show you an option. It's not going to show you an option because it's from an outside data feed. So once you've oh, there we go, it is actually available. So when you search for it, it should pop up the Fred feed there, add it onto the charts, and then you will be able to replicate that. So again, I just want to stress that we use this because there's normally a sharp inverse correlation, a sharp positive correlation between break-even inflation rates or just normal inflation expectations and oil, but it's not the only driver. That's very important. So we can use it to find possible value opportunities, but we always need to keep in mind there might be other drivers in play which might be the reason why we're not seeing that similar correlation or that usual correlation playing out. So I hope that helps with the questions, Hakeem. As always, don't hesitate to let us know if there's anything else.